Sunrise Bakery had a massive year, generating an impressive 8 lakh rupees in total sales across their fresh bread, cakes, and pastries. On the surface, that looks like total financial success. But how much of that 8 lakh does the owner actually get to take home? Looking at top-line sales in isolation is a dangerous trap. Revenue is just vanity. A business can move massive amounts of inventory while losing money on every single transaction. To see what's actually happening, we need to look past the balance sheet. If the balance sheet is a photograph, a snapshot of one specific day, the profit and loss statement is a movie, showing financial performance over a full month or year. This statement uses one uncompromising formula. It takes the revenue and subtracts every expense to find the net profit or the net loss. It is the only tool that strips away the illusion of gross sales to prove whether a business actually earned money during a specific time frame. Let's trace Sunrise Bakery's numbers to see what they actually kept. To build our P&L, we start the waterfall with 8 lakh rupees in revenue. First, we subtract the cost of goods sold, the flour, sugar, and packaging. For Sunrise, that's 3 lakh rupees. This leaves our first milestone, 5 lakh rupees in gross profit. Gross profit measures the basic viability of the product. It proves that the bakery can sell a cake for more than it costs to bake it, before any other business bills enter the picture. Now, that gross profit must cover operating expenses, the storefront overhead. This includes 3 lakh rupees spent on staff salaries, rent, electricity, and marketing. Once paid, we reach the second milestone, an operating profit of 2 lakh rupees. This is where management efficiency is tested. If another bakery pays double the rent or overstaffs its kitchen, those operating expenses swallow the entire margin and push the business into a loss. Operating profit reveals how much money the core business generates before dealing with outside debts or the government. We're almost at the bottom, but must slice away non-operating costs. Sunrise owes 40,000 rupees in loan interest, and the government takes 30,000 rupees in taxes. After these deductions, we find the net profit, 1,30,000 rupees. After every supplier, every single employee, and tax collector has been paid, this final fraction of the original revenue is the amount that legally belongs to the owner. This net profit figure carries over to the balance sheet, moving into the equity section and increasing the owner's net worth. However, there is a dangerous caveat. Profit is an accounting measure, not a bank balance. Profit is not the same as actual cash. If Sunrise Bakery sells a massive catering order on credit, the P&L logs that revenue immediately. The business looks profitable the moment the cakes are delivered. But look at the gap on the calendar. If the client doesn't pay for 45 days, the bakery is profitable on paper while having zero cash to pay its own staff today. The profit and loss statement proves a business is mathematically viable, but it doesn't prove it's liquid. To see if the bakery can actually survive next week, we need the third and final document, the cash flow statement.